So, uses of financial analysis. Whatever the financial analysis are made, these are so useful to taking investment decision, credit decision, and dividend decisions. Let's see in details. Financial analysis can be used to take the variety of decisions in the following area. For taking investment decision, analysis of financial statement helps an investor to know whether the firm is fulfilling his expectation regarding the payment of dividend, appreciation in the value of investment made by him, and safety of his investment. It helps him to take the decision about the continuation or discontinuation of his investment in the firm. For taking the credit decision, analysis of financial statement is useful in making the decision whether to grant or extend credit to the customer. Whatever the grant is provided to customer, it can be decided. Whatever the time period is provided to the customer for the credit, it is to be decided on the basis of financial statement analysis. For taking dividend decision, know very well after earning the good profit, it is very much compulsory for a company to pay a good dividend to its shareholder in order to increase the reputation of the company as well as to increase the market value of the shares of the company. No doubt it helpful to increase the wealth of the company as well. So dividend decision is one of the important decision is to be taken by the company. Such analysis is also useful in deciding that how much proportion of the profit is to be distributed as a dividend and how much is to be retained by the company. Now, the next use is for estimating the trend of the business. Analysis of financial statement for a number of years reveals the trend of the cost, sale, and profits. It also helps in assessing the future growth potential of the firm. The profits, sale, cost, that is increasing year by year or it's falling. The trend are all only just can be seen or analyzed with the help of financial statement analysis. For taking various managerial decisions, analysis of financial statement discloses the liquidity, solvency, and profitability of the business enterprises. It also helps in locating the weak spot of the business. Such information enables the management to take the various decisions to cope up with those weak spots as well as to make the business in a better position. So it is also very much helpful to take the managerial decision. Financial statement analysis has a lot of uses in order to take that various decisions, to know the trend, and to take the managerial decisions as well. Now, what is the significance and importance? Everybody has their own interest. If you remember in 11th class, we come to know there are so many users who are interested in the accounting information. Similar to that, there are so many parties interested in the business analysis, financial statement of the business, as well as the analysis of the financial statement. At present, the financial statement has become the general interest. Various parties have become interested in the financial statement of a company due to various reasons. Different person look at the same financial position from various angles. Like from a point of view of a supplier, you see the information in a different way. But if you are the creditor of the business, your way something else. If you are any banking company or a government, then you look at the financial statement at your way. Whatever the parties involved or who are the users of those information, they just consider that information as per they want. So the different persons look at the financial position from a different angle. They are the different users of the financial statement. All of them are using the same statement but for a different purpose. For example, a shareholder would be interested in the profitability, whereas the short-term creditor would be concerned about the liquidity. For example, the firm's ability is to pay the current liability. Therefore, the significance of the financial statement analysis may be studied from the point of view of the various parties. Let's study the significance from the point of view of various parties. Let's start with the management. Now see what is the significance of the financial statement analysis for management. Management is a firm is always interested in the solvency, profitability and capital structure of the firm. They want to make sure that the business must be in the solvent position to pay the debt as they fall due. Similarly, they are interested not only in the current year's profit but also the capacity of the business to earn the profits in the future years. By comparing the financial statements of the business with the help of financial statement of other firms in the same trade, management can draw significant conclusion about the sales, profits and expenses. The Justin work also has given its specific words about the significance of management that are the management can measure the effectiveness of its own policy and decisions, determine the advisability of adopting the new policy and procedures and documents to the honor the result of their managerial efforts. Now, the significance to investors. Investors are the person who invest the money in the business in the form of shares or the debenture or by providing the loan to them. So, significance to the investor is the investor and shareholder of the business are interested in the longevity of the business enterprises and therefore they want to know the earning capacity of the business and its prospects for future growth and prosperity. Analysis of financial statement of a company helps them a great deal in assessing the capacity of a business to pay the dividend at the higher rate and also the safety of their investments as well. Let's see how it is significant for the creditor. The creditor can be of two types. One is your short-term creditor, another is your long-term creditor. Short-term creditor want to know the liquidity of the business, that is, to know whether the company will have sufficient current assets and cash to pay their debt or no. Current ratio and quick ratio calculated on the basis of financial statement and help them in assessing this. Whereas the long-term creditor want to know two things, namely whether the company will be able to pay the interest consistently and whether the company will be able to pay their debt when they fall due. On the basis of interest coverage ratio, they can ascertain whether the company will be able to pay the interest regularly or not. And on the basis of debt equity ratio, they can ascertain whether the company will be able to pay the debt on the maturity. So in this way, financial statement analysis by telling us the liquidity of the business, by explaining the debt equity ratio, the solvency of the business, we can identify that how much company is capable to pay its debt to its creditor. So these analyses are also so much significant about the for the creditors of business or the company. Significance for the government. The government is the government can judge on the basis of the analysis of financial statement which industry is progressing on the desired lines and which industry needs the help. Government can judge on the basis of the analysis of the financial statement that which industry is progressing and which industry needs the financial help. Government can take a decision to reduce the GST on those industries where the profit margin are low in comparison to cost of production. On the contrary, in profit margin are too high in comparison to the cost of production, the government can increase the GST or can enforce the price regulation. Now, the significance for the financial institution. Financial institutions, those provide finance to the industries that are the banks, insurance company, or unit trust, etc. They want to know the profit earning capacity of the business and its long-term solvency. They want to assess not only the present position of the business enterprises, but also it likely the position in the future. And a financial statement helps them in ascertaining this. So financial institution also has significance of the financial statement analysis of a company. Now, what is the significance of financial statement analysis for the employees? Employees are the people who are working in that organization. They are the human asset in a way. So analysis of financial statement also helps the employees in determining the profitability of the business enterprises. They can ascertain as to how much bonus and increase in their wage is possible from the profit of the company. Analysis of financial statement also helps the trade union in negotiating wage agreement. Seventh, significance for stock exchange authorities. Stock exchange means the share market. They analyze the financial statement of a company to determine its price earning capacity and earning per share. EPS is very much important for the stock exchange. With the help of such analysis, the market price of the company's share is determined. Significance for the taxation authorities. The analysis, analyze the financial statements of the company to know whether the financial statement have been prepared in accordance with the legal provisions and whether these figures of production, sale, and profits are correct for the purpose of assessment of GST and income tax, etc. Researchers. Yes, it is also significant for the researchers as well. Analysis of financial statements of a company is of much importance to a researcher who is conducting research in respect of the profitability, efficiency, financial soundness, and future growth potential of that company. Significance of other parties. Some other parties may also be interested in the analysis of financial statement of a company from their own point of view, such as economists and trade association as well as the consumer organization. All these are interested in the financial statement analysis. So the financial statement analysis has a significant not only for a single party or a user, it is so much significant for all the users, whether it is management, its creditor, government, financial institutions, employers, stock exchange authorities, taxation authorities, researchers, and other parties as well. It also has the dark side. Financial analysis provide us so much significance as well as advantages. On the other side, it has some limitation. Limitation are that of the financial statement, as the analysis are based on the financial statement. And if the financial statements are correct, then only the analysis can be made correct. But sometimes the financial statements are incomplete or unauthenticated, or sometimes it is not correct. So whatever the conclusion are to be based on those financial statements will also not be correct. So it is also one of the limitation of financial statement. Affected by window dressing. Window dressing means the show off. Sometimes the financial statements are to be prepared in such a fine manner which hides the bad records of a company, which hide the bad position of the company. In a way, if a company is suffering from the financial crisis, but still the financial statement showing a good position, then analysis will be made good. It will not reveal the correct position of a business. So it also affected by the window dressing as well. The next limitation, do not reflect the change in price level. The figures in financial statement do not show the change in price level, because price level is going to be changed year by year. Sometime any increase in sale, let it do the example. In 2017, the firm sell 10,000 meter cloth of 10 lakh. In the same, and the same firm in 2018 sell the 10,000 meter of 15 rupees per lakh. It is close that the increase is 50% in sale, whereas the actual sale have not increased at all. The actual sale is 100 meter clothes, but per unit income has been increased. So it is very much sufficient adjustment. No price level has been considered here. Only the rise in the turnover has been considered over here. It is just an illusion. It don't reflect the change in the price level. It reflects only the change in the sales. So it is a wrong conclusion. Different accounting policies. Yes, I hope you remember all the policies, accounting standards, accounting concepts and convention that you learn in 11th class. everybody has their own personal ability. These accounting policies, if the two firms are adopting the two different methods, like the depreciation has two methods. One is original cost method, another is diminishing balance method. If the two firms are adopting the different method, then it is not possible and make the analysis or make comparison between that. And it is depend on the analyst that on which basis it is considering its personal judgment. So on the basis of the personal judgment and ability, it is also very much important that how the person who is analyzing, he should not be biased, he should be fair. Difficulty in forecasting. Yes, financial records are the past records, but we have to look into the future while making the planning. So it also becomes difficult to forecast on the basis of historical data. Moreover, there is a lack of the quantitative analysis. Only the quantitative analysis has been made, don't work on the quality. And single year data is not useful at all. With the help of single year data, we cannot make any conclusion.